would now like to invite Sudhir to moderate the next panel discussion on technology and venture capital profit with purpose. Over to you, Sudhir.
Hi. Thank you very much. It's been such a pleasure to have all of you join this session today. My first question is aimed to everybody. The renewed focus by financial investors in sustainable investments, is that a natural evolution? Is it a big trend right now? Is there a merger taking place between, ESG, impact, financial returns overall? And how is this, if there is, then how is this trend manifested over the past few years within your firm?
Investors have come to recognize that it's possible to be able to pursue any range of financial objectives and also get other kinds of returns. And so the desire is to recognize that capital can bring a financial return as well as returns in terms of development, in terms of environmental integrity, and that there are many of the exciting new opportunities in terms of investing into technology and into innovation that can help address both the development aspirations, the financial aspirations, and the environmental aspirations of the world that people want to live in. So in effect, people are looking to make capital work for real needs. And that's been a steady progression from, I think, an approach where the role of finance is only to think about finance, to recognizing that it needed to think about the risks that were being emerging from environmental and social trends, to now an orientation towards how do we invest into the future.
So for us, sustainability at Schroder's has been a continuously evolving approach. So we started off with our first dedicated ESG resource in 1998, and now we have more than 20 dedicated ESG specialists. We had our first sustainable strategy in 2007, and now we have full ESG integration across all asset classes. Mm-hmm. And then to further add to our overall sustainability capabilities, in 2019, Schroder's acquired a majority stake in Blue Orchard, who's one of the pioneers in impact investing. So they've invested $8 billion in over 80 emerging and frontier markets.
Okay. Excellent. Nicola?
Sure, I can comment from the DFC's perspective. We have definitely seen an increase in sustainable investments as a natural evolution. In terms of how it's impacted the fund managers that we see, because we're not actually a fund manager, we invest in fund managers, we've seen many more institutional quality impact focused fund managers come to our doors via this trend. We've seen the trend cause a shift in messaging and reporting amongst the fund managers. So there are lots of fund managers that have always been making impactful investments, but haven't necessarily been marketing their strategy in that way. The trends encourage these managers to create impact measurement tools to quantify development impact, and it's caused many of them to consider impact as a part of their core investment strategies. And internally to DFC, over time, as this trend towards sustainable investing has manifested, we've also shifted our own evaluation of managers and their ESG capabilities and impact. We've recently rolled out a new impact quotient. It's a new way that we're measuring the projected impact of our fund managers. And we are ramping up our ESG due diligence as well to be in line with this increased sustainable investing trend.
From our perspective, impact was, in the past, impact was implicit in many, if not most of our investments, given our focus on the emerging markets and businesses that are focused on the growing domestic economy. I think what's changed now is that we're still financial returns driven, but the impact assessment and alignment, measuring that is an explicit part of our investment process, our investment approach. So now it's important for us to upfront, assess the impact alignment, the intentionality of the impact, as well as how do we actually measure it, and trying to define that right up front, as opposed to letting it be something that's tangential or maybe just a byproduct of the investment thesis. So I think our own investment process, the way we do diligence, the way we monitor investments, that has changed to make it much more upfront and much more intentional as opposed to tangential. I think that's the big difference.
Have you seen a direct correlation between financial returns, and I'll add technology because we need, that's really solving a huge amount of problems which could never be solved before, and impact. Have you seen a positive correlation?
It was actually a very difficult question to answer for a couple of reasons. Number one, the lines between what constitutes impact products and what constitutes products that have impact is a little bit blurrier than it used to be. And then second, it's often quite difficult to compare strategies that had very different financial objectives to begin with. What we do know is when we've done our global surveys that try to take stock of the impact investing market, I think something like 90% of the respondents say that the investments they made were able to reach their reach their financial objectives or satisfy their financial goals. And I think that points to the idea that within the range of impacts that you could pursue, there's also quite a wide range in terms of the financial profiles and both in terms of the prospective return and the potential risk. So depending on, I think the way we've seen, and this is part, you can see this in the report, I think what we've seen is that for many impact investors, it's not a question of do I trade off one for the other? Do I try to have impact or do I have return? There's a whole range of different variables, including financial variables, that they all balance in terms of making a set of dynamic decisions about the portfolio they want and what they expect to get back from the portfolio.
We approach impact and financial returns in the same way where it's not one or the other. DFC is always investing in fund managers that are making impactful investments, whether or not they're calling themselves an impact fund manager. We can't comment directly on the correlation because everything we're investing in has to have a positive developmental impact, but we've definitely seen that these fund managers making investments in impactful portfolio companies then generate commercial returns.
I mean, so I can quote an example. So for example, we're working with foundations to invest in small to mid-sized businesses that promote fair labor practices. So most of the workers are unable to meet the basic needs through their employment. And so we see this as an improvement to improve, as an option to improve financial outcomes for SMEs as well as positively impacting social issues. Because if the labor force, at least for, let's say, for certain more industries than others, manufacturing or customer facing labor orientation, we feel that the labor force and social issues from that could backfire the company on its labor retention, profitability, and then as a result of that, not delivering on client expectations. So there is a trigger effect, and we believe that there is a direct link for good sustainability practices and financial returns. Yes, I agree with Sean and others that the line is blurring between what constitutes fair and good business practices versus an ESG quote unquote business practice.
Excellent. And Amit, a specific question as a corollary to this for you. Following these practices, does an entrepreneur or a GP get access to wider pools of capital? An entrepreneur is just in building his company. And the overload, if I may say, that's the question with many entrepreneurs, especially at the early stage, ask is, hey, there's a heavy load here. So, how much do I spend? And I understand it's an evolution over a period of time. But does it really open up pools of capital for an entrepreneur? He or her wants to build a stellar company. Any comments on that?
Even if the pools of capital stay the same, your ability to tap into those pools of capital should be greater, simply because I do believe that having the right framework, the right approach in this regard is going to help you deliver a stronger fundamental business proposition. And so you should be able to execute on your business plan better, and that should allow you to tap into the existing pools of capital better than a company that hasn't gone through that thought process and that operational framework.
Interesting. Point out that there is a growing interest within the institutional asset owner community in a number of the countries that have large pools of capital in how they could contribute to the SDGs. Still to be seen how that will develop and where that will lead them to focus, but that down the line might be something that does open up capital at volume in addition to opening up a higher quality of capital.
Sure.
I think it depends a bit which markets you're looking at, because I think if you were to go to European or North American or Japanese impact investors, I'm not sure they would automatically assume it's a bottom of the pyramid strategy.
Okay.
I think if you were to work with those that are in more closer to some of the more traditional development sectors, or some of the parts of the world that get classified as emerging markets, probably a lot of the impact opportunity does start more easily at the bottom of the period, because it's very much a combination of creating access, improving quality of life, and finding a way to leapfrog and do that at a low footprint.
We, of course, consider bottom of the pyramid impactful investing at DFC, but we also consider many other impacts. So you don't need to be targeting just bottom of the pyramid as your customer base. We look at things like providing capital to micro, small, and medium enterprises where they might be capital constrained. We look at deepening markets where a company can help to decrease imports and increase the exports, and ways that companies are increasing local income and jobs and tax revenue. So there are lots of other ways that we look at impact. It's not solely bottom of the pyramid, especially since we're also looking for a balanced portfolio of financial returns. We can't only be considering impactful investments.
How do LPs and how do financial institutions with ESG compliance sort of look at strategy diversification? Because that's coming out of the fact that you're creating enormous assets, which perhaps were not there earlier.
I think so for me, all of this has to go together. So as an omni-channel consumer product company, getting online, creating communities in today's age of marketing is just one of the key factors, success factors for a company like First Cry. And so for me, it's not a deviation in strategy.
Okay. Do something with it. I think it has to be much more intentional. It has to be much more structured. And then there has to be a measurement of, okay, how are we doing with respect to those objectives? So in that sense, there has to be a greater centrality to that thought.
Excellent. Tech interventions in impact investing, is that something which is going to be a big driver while building strong global companies, especially from India? Because traditionally that has not been the case in the past.
Absolutely, because I think tech, and I know one of the panelists, I forget who did mention this at the beginning, which is it's allowing for the leapfrogging, right? So when you've got underserved pockets of demand across a whole host of economic sectors, technology is really going to allow the leapfrogging. It's going to enable access. It's going to create more affordable solutions. And so absolutely, I think technology and the adoption of technology is going to be central to helping, emerging markets provide, or businesses in emerging markets provide, whether it's healthcare, whether it's financial services, whether it's consumer services of all sorts. I think there is massive potential there.
Absolutely, absolutely. Well, thank you very much. I think we're just about a minute away from closing, but it's really been a pleasure hosting you, and thank you for joining early in the morning in Washington and somewhat late in the afternoon in Zurich. From Amit, Nicola, Param, and Sean.